Hello everyone, and welcome to today's video where I'll be discussing an ETF that you may not have heard of before, and it currently pays out an insane 17% plus monthly dividend. This particular ETF trades on the NYSE Arca exchange and seeks to provide exposure to the volatility risk premium. Confused? Well, keep watching because I'm here to help. So let's dive in and learn more about this interesting investment option. The fund I've been recently researching is the Simplify Volatility Premium ETF, which trades under the ticker symbol SVOL. Basically, this fund shorts the VIX, but also buys protective calls on UVXY as a hedge. To understand how SVOL works, you need to understand what the VIX is. The VIX, also called the CBOE Volatility Index, is a measure of market volatility, and specifically the implied volatility of the S&P 500 index. Implied volatility is a measure of how the market expects the price of an asset to fluctuate in the future. The VIX is often referred to as the fear index because it tends to rise during times of market turmoil and uncertainty when investors are more likely to be worried about potential losses. Conversely, the VIX tends to fall during more stable periods when investors are more confident about the market. The VIX is calculated based on the prices of option contracts on the S&P 500 index, and these option contracts give investors the right to buy or sell an asset at a certain price in the future. By looking at the prices of these option contracts, traders can determine how much volatility the market is expecting in the near term. The VIX is expressed as a percentage, and a higher number indicates greater expected volatility. For example, a VIX reading of 30% means that the market expects the S&P 500 to move up or down by 30% on an annualized basis over the next 30 days. Overall, the VIX can be a useful tool for investors who want to gauge market sentiment and potential risk. Next, let's quickly understand what the volatility risk premium is. Simply put, it's the excess return that investors can earn by selling options or betting against volatility. It's a well-known phenomenon in financial markets that volatility tends to be overpriced, meaning that investors can earn a premium by selling volatility or betting against it. Now let's discuss how this Simplify Volatility Premium ETF, or SVOL, seeks to capture this premium. SVOL is an actively managed ETF that invests in a portfolio of options on the S&P 500 index. This fund takes long and short positions in options to generate returns from the volatility risk premium. The fund's management team tries to identify options that they believe are overpriced or underpriced. The fund also has the ability to allocate a portion of its assets to cash and other short-term investments, which can help reduce risk in times of market stress. This flexibility allows the fund to adjust its exposure to the volatility risk premium based on market conditions and the fund manager's assessment of the risk-reward trade-off. So why might someone consider investing in SVOL? Well, first, as mentioned, the volatility risk premium has been well documented in financial literature and has historically provided a source of excess return for investors. By investing in SVOL, investors can gain exposure to this premium in a convenient and cost-effective way. Secondly, SVOL pays out a whopping 17% plus dividend at the moment. Third, you get paid monthly as opposed to quarterly payouts like the majority of dividend ETFs do. And lastly, it could be a good way to diversify your portfolio into something outside of typical stocks or typical stock option ETFs. Now, one thing I don't like about SVOL is the current expense ratio of 0.66%, but it is an actively managed fund, and in my opinion, the 17% plus dividend makes up for that. But is it a good long-term investment? Is the dividend sustainable? Unfortunately, I don't think anyone has the definitive answer to that. What if the VIX skyrockets? I know they are hedging, but it still makes me a bit nervous. Now, I'm not trying to talk you out of this investment, but you should do your own research, and I would probably do some dollar cost averaging on the way in. I was reading through the comments on Yahoo Finance today, and one guy suggested the following. I own this in all my accounts, but I play it differently in one. I purchase on the ex-dividend date and take advantage of the drop in price, getting it at a discount. and then either sell or hold depending on the price action and build up into the next ex-dividend date. He further states that this only works for him on zero-fee platforms, but he also states that it has netted him the same or better than his buy and hold positions in SVOL. Just some food for thought. I'm not sure how well this will work for you, but I thought I would share what I found. I do already own JEPI, QYLD, and RYLD, but I will likely buy a small position of SVOL to put in my dividend portfolio to see how it goes. I'll be reinvesting all the dividends into more shares. Do you have any SVOL in your portfolio? I'd love to get your thoughts and opinions on this high dividend ETF. Thanks for watching. Please don't forget to like and subscribe, and all the best.